All right, I see a few more phone numbers logging in. We're going to go ahead and get started, everyone. Welcome. My name is Kirsty McPherson. I'm with Golden Shovel Agency. We're excited to have you here today. A couple housekeeping items. This webinar is being recorded. Many people request to be on the webinar, and they like to listen to the webinar afterwards. So we will send out to everybody who is registered for the webinar to be able to see and view this. So you'll have access to the slides as well as the full presentation. Today is going to be a pretty exciting one. I know this is a topic that I have with a lot of communities around how to model your ED incentive package. And we are lucky enough to have Paul here with us. And Paul is an economist and an Impact DataSource Principal. And this was founded in 1993 in Austin, Texas. And they're a consulting firm that specializes in economic and fiscal impact analysis. So Paul develops and provides support to Impact DataSource clients utilizing the firm's desktop and web-based economic development impact models. So this is going to be a super exciting webinar. I'm really excited for this. And like I said, everything is going to be recorded. Please notice your panel to be able to chat and ask questions. If you put the questions in at any time during this presentation, I will ask questions with Paul at the end. We'll have some time for that. So make sure that you're utilizing that, and if you have any questions in the meantime. So with that, Paul, I'm going to go ahead and give this over to you. And I'm very excited to listen to your presentation.
All right. Thanks so much, Kirsty. Thanks, Golden Shovel and Victor. Really appreciate having me join you today. As Kirsty mentioned, my name is Paul Scheuren with Impact DataSource. We're going to be talking about modeling ED incentive packages based on kind of our experience as our company. Just a few things which she touched on. Impact DataSource is an economic consulting firm based in Austin, Texas. We have over 25 years of experience evaluating economic development deals. Most often, economic development deals are going to involve some sort of economic development agreement and kind of modeling that incentive package. We have an online model called Impact Dashboard, which we license to over 100 ED organizations across the country, kind of really across the entire country in a bunch of different states. So we're located in Austin, Texas. We have a lot of clients in Texas. We have a lot in Florida, but we're really across the country. We also prepare reports as consultants, kind of on an individual basis, kind of as needed. The last thing there on the list, just to point out, is a podcast that my colleague, actually two podcasts, and my colleague Nicole D'Souza hosts, Economic Development Secrets and 123 CECD. If you're interested in the economic development industry and podcasts, go check those out. So we're talking about incentive packages, but I guess I'll start with this question of why are we even going to bother being concerned about modeling them, and why should we do that? And so I've kind of broken it out in a couple different areas here, or maybe some different reasons why clients come to us, or why some of our clients are using our software to model incentives. The first one, and this is the one that I think is most important now, I'll just say, is due diligence. And that's so that our client, the economic developer, the economic development organization, can kind of really review a project, understand the different components of the project. So you'll understand, the number of jobs, the capital investment, what industry it is, and so forth. And so all as a part of modeling an incentive package, you're going to get into those types of details. Another aspect to this is, as you're evaluating a project, is minimizing risk. And so in this process of modeling an incentive package, you're going to be able to see and understand the key parameters of the deal. So if it's a property tax abatement and you're going to be, let's say, abating a specific type of property, maybe the building, obviously it's kind of easy to think about that. It's like, well, if it's a 50% property tax abatement on the building, well, we get half of what we thought we were going to get in terms of those property taxes. But really, when we model the incentive package overall, you're going to maybe understand kind of that might just be the real property tax would just be one component of it, and maybe there's a big source of revenue from the other types of taxes that might be generated. So it helps you minimize risk by being able to take a broader view and understanding what are the most key parameters of a particular deal. The next two items kind of related, but that it helps you value the incentive proposal so that you can illustrate to the prospect the full value of the incentive to be offered. So to be able to say it's a 50% property tax abatement, but to be able to put numbers to that and show this is what we expect the value of that incentive to be over the next 10 years, or over the next 20 years, whatever it might be. And then finally, kind of related to that a little bit, but with a different angle. So if we're thinking about showing it to the prospect to say, hey, this is the value of the incentive, the other side of that is really transparency, being able to show your stakeholders the value of a proposed incentive, and maybe kind of demonstrating that you've kind of done that due diligence, being able to show on the up and up, this is what we're proposing, and we understand what we're proposing, so to speak. So that's kind of a couple points on why we should be concerned about modeling incentive packages. But I want to get maybe, before we go too much further, just a little bit more specific about how we think about, anyway, ED incentive packages. And we kind of, there's a lot of different things that kind of get proposed and get incorporated into agreements. And so we break them down really into kind of two big categories. One would be a tax incentive, and that's just going to reduce the revenue that would be received from a project. So an example of that is property tax abatement, or maybe a sales tax rebate, where the company, if it were to come in, it's going to pay some taxes, but this property tax abatement means they're not going to necessarily pay that full amount. And so it's just reducing a revenue that would be received. So that's a tax incentive tied directly to a specific tax revenue source. Then again, kind of using these very broad two different categories, we'll say there's a non-tax incentive, and that really represents something where it's closer to cash out of pocket. It could very well be cash out of pocket in the case of like an infrastructure grant, or the good old job creation grant, so to speak. But then you can also think of things that have, some real value. It may not necessarily be cash out of your pocket, but if you're talking about free or discounted land, that is kind of another form of a non-tax incentive. And so when we're putting packages, or when our clients are putting packages together, you can see it's not always necessarily one or the other. It could be a combination of multiple types of incentives from each one. In particular, more complicated projects or more larger projects might have elements of both types, might have multiple elements of both types. So that is kind of the setup here, and we'll look at in some examples later each of these types, a tax incentive and a non-tax incentive, and again, this idea of combining both types into one particular analysis. So now moving on to kind of this idea of modeling ED incentive packages. As we think about it, it really requires a framework for evaluating economic development projects. So maybe the goal is modeling the incentive package, but before we can do that, we need this framework for evaluating economic development projects. So as I note here, we really want that framework to be flexible enough to apply to the wide range of projects that you might consider. So you want your framework to work in the case of, let's say, more an office-based project as well as a manufacturing-based project. So if that's if you have that, maybe you have multiple target industries, so to speak. Some are more manufacturing-based, some are more office-based. You want one framework that will kind of accommodate both things. And so we think it's important to develop this framework in advance and then apply it consistently to all projects. So it's really difficult, as I mentioned here, kind of we want it standardized and not just ad hoc. So this idea that, oh, we've looked at 10 projects over the last 2 years, and each one had their own analysis because they were unique in their own way, and so we needed to, have a special analysis in this case, and then the next project came and we needed a special different analysis for that case. So it's really helpful to kind of develop the framework in advance, apply it consistently, and not be kind of adding, new ways to look at things every time you get a different project. And then, as I point out here, I would suggest that you don't ask for or accept an impact analysis from the business. So this is something that you really need to take take control of and be the driver. So it's kind of comparable to as if you were to provide estimates of projected sales or projected employment to the new business that's coming. That's not your position. So why would you accept kind of their impact analysis, their tax estimates from the business itself? So I really think this needs to be something that you're an active participant in, rather than just receiving, as I say, kind of that ad hoc analysis from company A and then receiving a different type of analysis from company B. It really needs to be standardized. It needs to be your process, and not something you just, in your application, you request that they provide the impact analysis. That's not what you should do. So I'm going to talk about a framework that we think is kind of flexible enough to apply in a lot of cases. So this is the way that we think about it, and I think in kind of general terms, I think a lot of folks will think about evaluating economic development projects, this framework here. Starting out kind of at the top there, we have economic impact, and that really is this idea that there's a new business coming in. They're going to maybe hire some workers. They're going to invest some money in property, and that's going to have an effect on your local economy. And then ultimately, that's going to drive fiscal impact. So that's kind of like the new tax revenues you might get. And then ultimately, we get down to this third level of the incentive package, where that incentive package could have, based on whatever it might be, it's going to have some feedback effects back to the fiscal impact. So let's put a little bit more meat on the bones with each of these. So as I mentioned, economic impact is kind of the start of it all. This is where a company is going to maybe locate or expand in your community. They're going to have these economic impacts of jobs and salaries. And if you want to, you can calculate the spin-off benefits to those. If you just want to focus on the direct part of it, you can do that. It's really, at this point, I mean, the framework is somewhat flexible, but I think these are getting some of the big parts here. So jobs and salaries are important, of course. The capital investment has an economic impact. And then I have also kind of a little bit of a weird one called residential development impacts. And this is, we think, a pretty important one. And it's a little confusing maybe to think about what that is, but essentially, if you have a company that's going to create new jobs in a community, some of those positions might be filled by people that relocate to the area. And so that's going to have this residential development impact on the local community. So you're going to have, essentially, we can call it like population impact. So there might be new worker households moving to the area. So there's some new residents in the area. Some of those might build residential property. Some of them might have school children. And so there's all these other follow-on things that come from just this initial impact related to the jobs. Now, next up, we have the fiscal impact, and kind of just broadly speaking, we'll get into more detail on this. We think of it as the net benefits for government. So essentially, that's your additional revenue, tax revenues, other things, minus the additional costs that might be associated with some of this new business activity, some of this number of new households and so forth. So when we say net benefits for governments, it really, it's simplified there, but it can get messy in terms of, we want to be able to look at the net benefits at each level of government. So for example, we want to know the net benefits for the municipality, for the county, for the school districts, and all the different local entities. It's going to be helpful to be able to break those out essentially line by line, rather than just taking a look at the total property tax rate in the community and multiplying that out and saying, okay, this is the overall benefit for community. And maybe you want to roll that up, but ultimately you want to be able to break it out to see by the jurisdiction, what are those net benefits. And then finally, this incentive package, as we talked about these two different types, just broadly, of incentives. You've got tax incentives, and they're going to feed back into the net benefits. So essentially, we thought we were going to get the full amount of the property tax, but because there's this property tax abatement, we're not going to get that full amount. So that kind of reduces your net benefit. And then on the non-tax side, what we would do there, we would compare your non-tax incentive to the value of these net benefits over time. So for example, we think of that non-tax incentive as an investment in the project. The net benefits are your return on investment. And so that's a little bit of how we're approaching this with this framework. So I'm going to start with an example now, just kind of to show some of how this works, and we'll kind of look at maybe a couple different possible rough frameworks, and then we'll go even deeper. So the example here, we're just thinking about a headquarters relocation, so kind of an office project, so to speak. So it's a professional services company, but we're looking at their headquarters location. They're going to invest, in this case, a total of $145 million. They're building a building. A big chunk of it is to construct a building, and then they're going to add some equipment and machinery, so forth, the FF&E, of about $15 million. They're hiring 700 workers over the next 5 years, and their average salary is $125,000. So this is kind of, just a typical maybe headquarters project. If this isn't, really speaking to the types of projects your community gets, we're gonna look at a couple other examples too to see how all of this kind of applies, not just to headquarters projects. So stay with me. So we can kind of go at maybe two ends of the spectrum here. I'm going to give an example of two possible frameworks. So kind of starting from that broad framework and then actually looking at how it gets applied. We could just have a simplified version of this where we just focus on the major revenues. So number one, we're going to limit it to revenues. We're not going to be concerned about the additional costs that a government might have to, provide services to new residents and the new business and all of that. We'll just focus on the revenue, trying to simplify, the analysis. And again, we're going to focus just on the major revenues. So I've noted property taxes and sales taxes. I'm going to, in my example that we're going to get to here in a moment, we're going to be looking at a Texas community. In the case of Texas, at the local level, property taxes and sales taxes are kind of the major drivers of revenues. Other states might be different. So for example, we work with a number of communities in Indiana, and they don't have a local sales tax there. So you might be more focused on property taxes and local income taxes. And so at least across the country, property taxes at the local level are one of the major drivers of revenue in almost all cases. So honestly, if we're doing a simplified version of everything, focusing on the major revenues, understanding the property taxes is going to get you at least 75% of the way there, most likely. So a simplified version can be okay. And as we're looking at here, it's really just focusing on, in this case, for maybe a Texas community, two sources of that revenue. Now, on the detailed side, we have the option potentially to do more of a comprehensive cost benefit. So we're going to include both the revenues and the costs, so the additional taxes and revenues, as well as costs. So we're going to estimate additional revenues beyond just the property and sales taxes, try to understand what are some of the other sources of revenue for that particular tax entity, whether it's the city or the county. And then we also want to estimate marginal costs to provide those government services. So we're going to get into kind of taking this another step. But the detailed analysis can really bring to light some other things that might get missed if you're just focusing on those major revenues. So I've got a couple screenshots of how this might play out. So first off, if we take this headquarters relocation with 700 workers and $125,000 in salaries and $145 million in capital investments, this is what it would kind of look like, again, for this example anyway, in the city of Arlington in Texas. If we apply that here and we're focused just on the major revenues, we can see kind of what we're looking at here, these dark blue, or excuse me, the lighter blue boxes down the center of the screen, the jobs, salaries, capital investment, that's listing out those economic impacts that we talk about. And then we're translating those economic impacts into our fiscal impact, which in this case is a little bit simplified. We've got the benefits of about $11 million. We're not calculating any costs or estimating any costs. And then we've got the net benefits ultimately right there of the $11 million. We're running this out over 15 years in this particular case. And we can see the source of those benefits, $3 million in sales taxes, and then a little over $7 million in different types of property taxes. And so that that gets us pretty far along. This one is even, we say it's simplified, but we're including some of the spin-off impact, as you notice here, of if there's 700 direct jobs, there's might be 500 additional spin-off jobs supported. You wouldn't even need to go that far, but we're going to see in a moment when we start applying or when we start modeling the incentive package, how all of this comes together. So this is, at least on the simplified version, this is what it looks like. Now, if we wanted to get a more comprehensive look, we go to this detailed comprehensive cost benefit analysis. And again, it's all the same impacts in terms of those economic impacts. We're still including the direct and spin-off, same $145 million of capital investment. Now we're showing benefits of about 20 million. We've got some costs pulling out about 8 million there, and it's net benefit of about $12.5 million. If we look on the right-hand side, that's where there's quite a bit of difference from before. We've still got that inclusion of sales taxes and property taxes, but now we can see we've got some additional revenues. In this case, focused on the city, so we're picking up some new residential property taxes, again, kind of taking into account that residential development. And we're going beyond just those major revenue sources for the city to look at some of the other revenues that the city might receive. And on the cost side, we're picking up some of the estimated costs that the city might bear to support this project. So we can see we've got both things, both options here, but the comprehensive, obviously, is going to take a little bit more work to get things set up, so to speak. But now, so that's really just kind of those first couple steps of the process, and now we want to get to this incentive package part where we are actually modeling the tax incentives and modeling potentially the non-tax incentives, and see how that comes together once we have that initial framework where we calculated our fiscal impact. So for our headquarters relocation incentive package, what I'm going to start with here at least is just a 40% building property tax rebate over 15 years. So we're going to run this out over 15 years. It's a property tax rebate. And so what does that mean ultimately? I mean, this goes back to the idea that this is a tax incentive and it's reducing a revenue we were going to receive. It's going to reduce real property taxes for the city and the county. So I'm going to continue on in our example, looking at the comprehensive cost benefit version. You could certainly use the major revenue approach if you wanted to keep things more streamlined, but we're gonna go in the full detail here. I'm going to switch over now to our actual Impact Dashboard software. So we'll just jump out of the PowerPoint here for a moment and take a look at our model. Again, Impact Dashboard is our web-based impact software. It provides this framework for evaluating ED projects and for modeling those incentives. So let me pull that up right now. I've got our headquarters relocation project. This is what Impact Dashboard looks like. We're kind of stealing some screenshots out of here in those other slides. And we can see all the same information that we just had for the comprehensive cost benefit report. We haven't applied any of those incentives yet. So what we want to do is apply a 40% building property tax rebate over 15 years for the city and the county. We don't really need to worry too much about the mechanics of doing this in the software, but I'll do that while we're here. So I'm going to click on our tab here at the top for the public support, and we're going to be able to just kind of enable this property tax rebate that I've already entered in. So right here we can see I've plugged in 40% as the property taxes to be rebated over the 15-year period. If I check that box, it's going to update our numbers over here. So this is showing us an analysis of just the property tax rebate. So if we're just trying to understand the graphic, we've got these dark blue bars. These are showing us over the 15-year period the total amount of property taxes to be collected by the city of Arlington on the firm's property. So again, we're taking the investment, which is $145 million. We're figuring out what the taxable value of that property will be. And then we're applying the city's portion of the property tax rate. So for example, in year one, that's about $500,000 of property tax that we're expecting. Now we do that over 15 years, and if we add all those up, that's $7.7 million of property taxes. Now, we're considering a rebate where the city will rebate 40% of the building property taxes. And that we're calculating out here as essentially a negative, as we see, of in year one. That's going to equate to about $165,000. And if we added that up kind of all over those 15 years, that adds up to about $2.8 million. Okay, so we're starting out where we were expected or scheduled to get 7.7 million. We're going to rebate 2.85, and now we're down to our net collections of about $4.9 million. We can see that, like for example, in year one, we were expecting to get 500. We give up some of that. We're getting a net of 342. So there, if we look at this orange line stretched out, we can see that's the $4.9 million in the net taxes. If I click here on our table view, we can see actually these values year by year if we wanted to get that more clarity. The graph is nice to help us see kind of how that goes over time. Now, we were going to do that for the city, as we see, but we were also going to do that same property tax rebate from the county. So let's go ahead and do that. I've done the same thing here with our 15 years. I'm going to enable that. Now we can see, in terms of valuing that incentive from the county's perspective, they were expecting to get about 2.8 million. They're going to rebate about $1 million, so they're getting, on a net basis, 1.8. These are different numbers, obviously. The graph kind of looks almost exactly the same, but it's really just because we're using a different property tax rate, the city versus the county in this case. And now if we go to our, let's say we go to our report, we'd be able to see, first off, for the city, that our net benefits have dropped. Earlier, they were about 12.5 million. Now they're down to 9.6, 9.7. As we get into the detail here, as we look at the detailed list of our revenues and our costs, we can see our real property taxes now have an asterisk showing 4.2 million. We can see down here, this asterisk is telling us that we're excluding the property tax rebate from this. So we've already backed out, we've reduced that revenue by $2.8 million. So our net benefits ultimately have dropped by that $2.8 million. So that is how we're modeling it specific to the city. Now, if we were to go and we could look at the county, a similar thing is happening. The county has real property taxes with an asterisk. It's showing that the property tax rebate is valued at $1 million here. So we hadn't looked at this earlier, but our net benefits for the county would be $1 million higher without that property tax rebate. We can look at a couple other places to see some of this information. Let's actually look at our summary report. We can combine the two, the city and the county. We can see the full value of that property tax rebate across both entities is about $3.9 million. So that is one of those ways where we're kind of looking across all of the districts participating. The value here in this case from that city county property tax rebate is about $3.9 million over 15 years. Now, we talked about this idea of tax incentives as well as non-tax incentives. And so let's imagine a case where not only did the city want to consider this property tax rebate that we saw of $2.8 million, but the company has requested a $5 million infrastructure grant to be paid out upfront to help kind of get the site up to speed. So if we wanted to do that, we can go back and model that type of incentive as well. We're going to go back to our cities tab. This is our property tax rebate. This is what we've got in here already. I'm going to scroll down. We're going to pass a sales tax rebate on those initial purchases of construction materials and FF&E. If we wanted to get into that, we could, but I'm going to skip it. And now I'm going to get down here to our non-tax incentive. In this case, we're considering a $5 million infrastructure grant. We're going to compare that $5 million investment to the net benefits that the project generates. This is the 9.7 million over the 15-year period. So if I plug in 5 million here, we're going to be able to calculate against that net benefit, against that return, a payback period and a rate of return. So let me do that right now. If I plug in $5 million, let that calculate. We can see our graph updates immediately. We've got this $5 million paid out in year one. And we've got our net benefits kind of accumulating over time between years 7 and 8. It looks like we're hitting kind of that intersection point. That identifies our payback point. So here, 7.7 years shows us the point at which the project will generate enough net benefits to cover the value of that $5 million incentive. And we can just do a little bit of math on the rate of return. So looking at the average annual rate of return, the $9.7 million is what's received over 15 years. That's what was received kind of average over the $5 million. So we see 12.9% average annual rate of return. So this net benefit, so this going back to that framework, thinking about fiscal impact, driving those net benefits that we're going to see for the city, we're using that as the basis to compare this $5 million incentive. Now, if we go back to our report, we can kind of see everything that's incorporated into that. So we're getting net benefits of $9.6 million. That accounts for this property tax rebate of $2.8 million. And if we invest $5 million for infrastructure, as we were considering, that's going to get us paid back in 7.7 years. Now, you might look at this and say, well, that's too much. The city might say, well, that's too much that we're putting into this deal. That's more than what we want to do. So let's consider a situation where we only do one of these. So right now we've got them included together, but let's say the city doesn't want to do this property tax rebate, but we will consider the $5 million. So what's going to happen if I uncheck this, we'll get rid of our rebate and kind of go back to normal. So now our net benefits have not been reduced. And so if we scroll back down here, our non-tax incentive is being compared against that original $12 million in net benefits. And so now our payback period has shortened. So it was 7.7 years before. Now it's 6 years to hit that payback point because we're not giving up the 40% of the building taxes. Our rate of return has increased as that payback period has shortened. And so now we can see exactly what that looks like on a $5 million incentive where we do not offer that property tax rebate. So again, the modeling here is really nice to be able to kind of go back and forth and play with those different scenarios where now we're back up to the full amount of real property taxes for the city, but only considering now this $5 million, and we see that payback period. I want to take a look at another example just to kind of show some differences potentially here. We were talking about the headquarters relocation incentive package, but now let's go to another example. So the example we just looked at was essentially an office project. We took the information about that project, we estimated the economic impact, we translated into fiscal impact, and we got those net benefits. Well, that actually proves really flexible because we can do that not just with the headquarters relocation, but we could also do it for a manufacturing project. So in this case, I've got a different setup. So we've got a wood products manufacturer. They're going to invest $28 million, so quite a bit less than the $145 million of the last project. In this case, they're going to be pretty heavy on the investment of $25 million out of that 28 on the equipment and machinery. So it's a little bit different setup. We're only investing $3 million in the building in this case. And we're going to hire, in this case, only 80 workers. The other one we were talking about, like 700 workers making 125. In this case, we're looking at 80 workers earning about $45,000 a year. So if we want to plug that one into our model and kind of boil it down to those economic impacts and those fiscal impacts, we can do that as well. Let me jump back into our model. I'm going to jump out of our headquarters project, and I'm going to find our manufacturing project. I'm going to use our comprehensive version of that again, just to keep things consistent with the last one we looked at. So I've plugged in this case, our 80 jobs for the manufacturing project. I've plugged in the $45,000 salaries and then the $28 million of FF&E. If I go to our report, in this case, we can see, obviously, this is nice. We've got that same consistent structure to our model, to our report. We're seeing, again, our economic impacts on the right-hand side, showing us the total number of jobs, the average salary across all those workers, the capital investment noted, the residential development as well. This one obviously just has a little bit different profile than the last one. And it's a different industry. It's got a lot of different, differences between the last project we were looking at. In this case, and we're actually only running this one out over 10 years, whereas the last one was looking at a 15-year incentive, so we ran the project over 15 years. This one, we've got benefits, costs, and net benefits at the top there. Again, we can see our our net benefits are about $1.6 million over the 10-year term. As we scroll down here now, we can see the source of those benefits. This one, pretty heavily driven by our FF&E property taxes, $1 million of ultimately the $1.6 million is coming from FF&E property taxes. So that's interesting to see. Again, a difference from the previous project. But now let's go and model an incentive here. I'm going to make something up as we go along, but we'll do first maybe a property tax abatement. Again, the city, let's consider the city doing that. We'll do a 50% because that's what I've got plugged in. I'll turn that on. Again, this is working out kind of the same way as the last project in terms of showing us the total amount of property taxes over the 10-year period. And then the amount abated in this case instead of rebated, just a small amount. So ultimately, total property tax expected is about 1.4. We're going to not receive all of that if we offer the 50% rebate. That's 120,000, so not that large compared to the property taxes over 10 years. So 1.3 million in net collections ultimately. We can see there's some dynamics going on in this one that were not going on in the last one. So these property taxes are declining kind of significantly over the 10-year period. I can tell you what's happening. It's the majority of the investment of the $28 million is taking place in the furniture, fixtures, and equipment. That FF&E is going to be depreciating over time, and so the amount of tax that we expect to get from that $25 million investment is kind of declining as we look at this. And so even though the real property tax is 50%, is kind of staying relatively consistent over the 10 years, the overall taxes are declining relatively significantly. Again, that has to do with our assumptions about depreciation in this case. If the county were going to do something as well, maybe they're going to do a different type of schedule, you could model that. In this case, I've got the county doing a 100% in year 1, down to 10% in year 10, just kind of phasing out, so to speak. If I go to the report now, we can see from the city's perspective, we're going to pull out the 120. So now our net benefits drop by $120,000 down from 1.6 to about 1.5. Now, if we wanted to look at an incentive in this case, maybe again, this idea of stacking multiple incentives on top of each other. If we go to our city, let's say the city was going to offer a $7,500 per job incentive. And we can model that here. I'll plug in $7,500. We had 80 jobs total. We were actually having 40 jobs in year 1, 40 in year 2. So as we just kind of multiply that out, we can see the two kind of investment amounts in years 1 and 2 adding up to 600,000. So our kind of bar here, or our line, is showing our total incentive amount of 600,000. Our intersection point occurs somewhere between years 2 and 3. We can see that. And actually, we calculated 2.3 years, 25% average annual rate of return in this case. So this case, you can see we're applying our investment, our non-tax incentive in 2 installments, kind of consistent with their actual hiring. You could phase these out in different ways if you thought that was important. You could put those kind of in a later year or something like that. But again, our report is going to show these results. We can see our net benefits kind of, slowly increasing as we get into those later years. But again, the framework is the same. We've got these net benefits, in this case, $1.5 million of net benefits. We're comparing that to our investment, in this case, of $600,000, so we can calculate that point. So that is kind of a couple different options for combining these things. I also have another scenario that I'll look at real quickly, and that's in the case of a, in the case of a, TIF district, we can think about that as well. I won't go into as much detail on this one, but here's our hotel and convention center. The same type of process would be done to understand what's the economic impact of this hotel, how does that translate into fiscal impacts in our community based on our tax structure. separating that out maybe for the city, the county, and the school district. And then this final component, this where we model the incentive package, it's going to come into play here as we look at what's being considered, where there's a TIF district to be created, and the city and the county are going to contribute 70% of the real property tax, the tax on real property improvements. So the incremental tax is essentially the 75% from the city and the county. And so if we kind of just stay in our PowerPoint, I've got a couple screenshots, even though we could look at this in the model as well. We're showing, just to kind of get a high-level sense of how this gets done. The mechanics get a little more complicated, but essentially, here's the hotel fiscal impact if we have not applied the TIF yet. So this is kind of that first stage before we get the feedback effect of modeling the incentive package. In this case, what I want to draw attention to is essentially our city of Arlington is getting, let's focus on the doesn't really matter. Let's focus on the net benefits of 29 million. Let's also look at Tarrant County getting about $2 million. Overall, on the total, it's about $38 million. Now, if we apply a TIF district, the way it works here, at least in this case, for our Texas example of a TERS, a tax increment reinvestment zone, the city and the county are going to give up a big chunk of their taxes to this TIF entity. And ultimately, the bottom line, the total, isn't going to change, but we are going to reduce what the city gets and what the county gets, and we're going to have this new entity. So what happens is we can see now the city's net benefits have dropped to $25 million. The Tarrant County's has dropped to $500,000. And where did that money go? We can see we've got a new line item there at the city TERS of in the net benefit column, 5.8 million. But the total across everything is $38 million. So if we look at this with our TIF, we can see that new line item has popped up. But really, all it has done is kind of redistributed those taxes that the city was to expect, the county was to expect, and contributed their share now to this TERS from the city's perspective. So that is everything I wanted to get through. I know we've got maybe 10 more minutes or so. There's a lot going on, but if you have questions, feel free to type those in. Maybe you had some as we went along. I skipped over a lot of some of the detailed modeling to get through the economic impact to the fiscal impact and so forth, but I really wanted to focus on how we would think about modeling an incentive package and applying kind of those two different approaches around tax incentive versus non-tax incentives. I guess I'll see if there's any questions at this point.
Perfect. All right. Again, you can type in questions. There's a dashboard at the bottom of your screen. If you hover over the bottom, you can input any questions.
And I'll say we have, as we talked about this, we looked at some comprehensive ways to do things versus more of a simplified approach. And the software that we put together makes it really easy to go into the kind of comprehensive approach where we kind of do a lot of the research and get things together. But the point of all of this really for economic developers is to try to understand what the potential incentive package will mean, or what's the value of it, how it will work kind of mechanically. And so even if all you do is focus on your major tax revenues in an Excel spreadsheet, and maybe you just do a couple of years, or you try to get some of that dynamic, that's going to be a big step in the right direction. This way, it's going to get you maybe 75% of the way there. But you can certainly get more detailed, and it'll capture some more nuance as you go.
Perfect. I'm not seeing any questions. Oh, here we are. So this question comes from Arlene. What do you consider the value of a job at $45,000 a year, the multiplier?
Yeah, so I'll jump over to our our model here. So we were talking about, this was our manufacturing project. We had, in this case, it was 80 jobs, and we had a $45,000 direct salary. So it's difficult to kind of boil it down to a value on a single job, right? Because if you just had one person, let's say you're working from home, you make $45,000 a year, and that's all there is. Honestly, it's not that big of an impact. You're going to have, the way I think about this coming through, and if that was the only thing that was happening. So you didn't work in an office or in a facility that, you know, represented taxable property, and you were just receiving your $45,000 salary. Well, you might go spend some money in your community, and, you know, that some of that might get taxed. So if you go to the grocery store or, you know, restaurants and all these different things, you're going to have an impact. But really, we're talking about spending a kind of a portion of this $45,000. And so the impact, as we try to tie that to fiscal impact, it's probably not going to be that significant. When we think about a project, you know, there's going to be, in this case, there's actually 80 workers, and they work in this facility that's going to be on the tax rolls maybe for $20, $30 million. And so that, as it comes together, has a little bit more meaningful impact. So obviously, one way to think about part of this would be maybe to divide the $1.5 million in the net benefits by 80, and we get some value as a per job in this case. But it really includes all these other attributes about the project as well. And it could differ, you know, from a one person working at a manufacturing plant versus one person making $45,000 working at a different type of impact. Now, you asked about the multiplier, and so I'll just kind of show briefly, when you are modeling this, just the way we see it here on the screen, or if you're doing this kind of on your own, what you would want to do to get the multiplier would be to either use some sort of economic impact model. In our case, we're using RIMS 2 multipliers from the Bureau of Economic Analysis. So in this case, as the industry is this wood product manufacturing entity, we're pulling in a multiplier of 1.29. So the things that you need to know about multipliers, number one, they need to be region specific, which is kind of what we do when we put this model together. We give you region specific multipliers, but then they also need to be industry specific. And so you're going to need to tell us what industry is this project represent. And so in this case, wood product manufacturing for this community has an employment multiplier of call it 1.3. So 1.3 means that for every direct job that's created, there's 0.3 spin-off jobs created elsewhere in the community. So what's that mean? So you've got, in our case, if we're trying to boil this down to just one person making $45,000 a year, you've got the one direct worker and then 0.3 spin-off workers. So maybe we think about it in terms of, you know, we have 3 workers, and then that accounts for 1 full additional spin-off worker. So it varies. So the answer is going to be it varies based on the other attributes of the project. What's the capital investment? Where do they work? What do they do? What are some of the attributes going on? And really, when we get to the multiplier, it depends on the specific industry. They're going to be different for you know, a manufacturer versus a headquarters. They're going to be different, like in our hotel example as well. You're also going to have differences region-wise. So if you're a small city, we might want to focus, well, what's the actual job creation in your city versus your county versus your state. Those are going to be larger numbers. You're going to have a bigger impact the wider it jumps out.
Okay, so using the 80 jobs, the multiplier effect is 24 jobs if it is 0.3 per job. This is the follow-up question.
Exactly.
Perfect.
Yeah. So there, I'll get that window off the screen, but now we can see our detail about jobs. We had 80 direct jobs. Applying that multiplier, which was just under 1.3, it's about 24 spin-off jobs, so the total is, in this case, about 104 total jobs. Yep.
Perfect. I'm not seeing any other questions. Oh, yep, perfect. So if anybody has any follow-up questions, and I'm sure for those that are going to be listening to this recording, Paul, do you want to pop up your contact screen one more time? And that'll just kind of show everybody who will be listening to the recording your info.
Yep, sure. And feel free to reach out if you have any questions. Our website has a lot of information about what we do and even kind of a lot of what we talked about today of how we estimate economic impacts and so forth. So feel free to reach out directly if you have any questions.
Perfect. Well, thank you so much for your time today, Paul. This was great, super educational. And like I said to everyone, this is recorded. We will send out the links in the webinar probably on Monday. So thank you all, and thank you, Paul.
Thank you. Appreciate it. Thanks, everyone.
Everybody have a great week.